Ever look up at a brand new skyscraper and just wonder, how? Who puts up hundreds of millions of dollars to build that, right there? It looks like a huge gamble, right? Well, it's actually one of the most calculated bets in the business world. Today, we are pulling back the curtain and decoding the financial blueprint that turns an empty plot of land into the cities we live in.
So how do developers bet a fortune on what looks like just a patch of dirt? Well, here's the secret. They don't really bet at all. It's a science, and it's all built on incredibly detailed financial models that can predict profit years, sometimes even a decade, before a single shovel hits the ground.
The crystal ball for this whole process, the one document that matters, is called the feasibility report. Now, this thing is a dense, jargon-filled blueprint that projects every single dollar that will be spent and every dollar that will be earned over the entire life of a project. It is literally what stands between a cool idea and a billion-dollar green light. Okay, so to crack this report open, we need to know the language. You need the right tools. So we're going to quickly cover the fundamental metrics that developers live and breathe by. These are the numbers they use to size up any project.
Let's start with the old school method. It's called the development margin, and it's super straightforward. You just take your net profit and you divide it by your total cost. So you spend $80 million, you make $20 million in profit, congrats, you got a 25% margin. It's simple, it's easy to grasp, but it gives you a snapshot that misses something absolutely crucial.
So what's the big flaw in that traditional margin? It completely ignores the time value of money. It pretends a dollar you earn 5 years from now is the same as a dollar in your pocket today, and we all know that's not true. That's why modern analysis uses something called discounted cash flow, or DCF. It's built on the principle that money you get sooner is way more valuable. And for a project that's going to last almost a decade, this isn't just a better way to do it, it's the only way.
And one of the most important numbers that comes out of a DCF analysis is the internal rate of return, or IRR. The easiest way to think about this is that it's the project's own annual growth rate. The bottom line is simple. If your project has an IRR of, say, 15%, but your bank loan is costing you 16% in interest, you're actually losing money. The IRR has to be higher than your cost of capital. No exceptions. All right, theory's over. Now that we have those tools in our back pocket, let's see how they work in the real world. We are actually cracking open a real feasibility report for a project in Australia. This is where it all gets very, very real.
So first off, just take a look at the sheer scale of this thing. We're talking about an 80-month project. That's almost 7 years from the first day to the last. It's an 81-unit development, and it requires over $173 million in total funding. I mean, the numbers are just massive, and the timeline is incredibly long, which is exactly why that simple, old-school margin metric just wouldn't work here.
Now, buried deep inside this report is the magic number. It's the developer's target. They will not move forward. They won't even consider it unless their financial model spits out a profit margin of at least 20% on the total costs. That's their benchmark, their go/no-go line. Anything less, and the whole thing is dead in the water.
So, this is it. This is the moment of truth. After dozens of pages of cost estimates and sales projections and cash flow analysis, does this $173 million project actually hit that 20% target?
And the answer is yes, but just barely. The final calculated gross development profit margin comes out to 22.25%. It clears the hurdle. So based on this base case scenario, this project gets its first green light. It is officially considered feasible. You might be wondering, where does a cool $173 million come from? Well, about 27% of it is equity. That's the developer's own money, their skin in the game. The other 73% is all debt, split between one loan just to buy the land and a much bigger loan to pay for all the actual construction.
But here's the thing. A successful project isn't just about the main forecast looking good. The real test is planning for what could go wrong. The world is a messy, uncertain place, and smart developers have to stress test their numbers against all kinds of potential disasters.
And this is where something called sensitivity analysis comes in. You can think of it like a financial fire drill. The model starts asking a whole bunch of what-if questions to see just how fragile the project's profit really is. They're basically trying to find the breaking point.
Let's throw a very real-world wrench into the works.
What happens if, thanks to inflation or supply chain chaos, construction costs suddenly jump by 10%? Does the whole financial model just fall apart?
Well, the report gives us the answer right here. In a best-case scenario, if costs actually fall by 10%, the margin gets a nice little bump to over 24%. But in the worst case, that 10% cost increase drags the margin all the way down to 20.18%. That is razor thin. It's dangerously close to their 20% minimum. It shows that, yeah, the project works, but it does not have a lot of wiggle room if costs get out of control.
So, after all the number crunching and all the stress tests, it is time for the final verdict. How did the people at the top take all this data and make that one final multi-million-dollar call?
Well, it all boils down to a final dashboard of what they call key performance indicators, or KPIs. It's not about one magic number. A project has to pass every single one of these tests. Does it create real value in today's money? Is its rate of return higher than what the bank is charging? Is the amount of debt manageable? It's a total financial health check, and a no on any of these can kill the entire deal. It has to be green lights all the way down.
So, the next time you walk through a city, just remember, every single building you see, from the tallest skyscraper to the smallest apartment complex, it all started its life not as brick and mortar, but as a series of calculations and projections in a feasibility report, just like this one. It's a system designed to take the gamble out of it, to minimize risk and maximize returns. But it's not perfect. And it leaves you with this fascinating question when you look up at the skyline. Which one of these buildings passed all the tests on paper, but maybe, just maybe, shouldn't have been built?